The Senate passed sweeping tax cuts early Wednesday morning, sending Americans across the country and in all income brackets scrambling to find what it means for them. After passing an expected House of Representatives revote, it will impact large parts of the U.S. tax code, including a huge dip in taxes for corporations from 35% to 21% starting next year, and rules governing bringing overseas profits to the U.S. The bill will also lower taxes on average in the short term for all income groups, though those benefits will phase out after 2025, leaving gains largely with the top income groups, according to analysis from the Tax Policy Center. Standard deduction: one major change likely to affect what Americans do in April or earlier for those who don't procrastinate is a near doubling of the standard deduction to $12,000 for individuals and $24,000 for couples. This means that it will not be worth it for millions of Americans to itemize their tax returns in hopes of lowering what they pay. Bracketology: brackets will now be 10%, 12%, 22%, 24%, 32%, 35% and 37%, representing slight decreases, but with shifts in the size of each categories moving many workers down to a lower level. A couple with an income of $76,000, for example, would move from paying 25% under the current levels to paying 12%. Caps for each level for couples are $9,050, $77,400, $165,000, $315,000, $400,000 and $600,000 before reaching the top rate of 37%. For individuals, the caps are $9,525, $38,700, $82,500, $157,500, $200,000 and $500,000. Though deferring income into 2018 is not possible for most Americans who get paid on a regular schedule, some tax experts have suggested that employees could try to get payments such as year-end bonuses put off until the new year, when they will be taxed less. State and local taxes: much of the debate about the bill centered around the elimination of SALT deductions, where residents can deduct the amount they pay in state and local taxes in their federal returns. Getting rid of the deductions disproportionately affects those in the Northeast and California, where property taxes for many homes costs thousands of dollars each year. Objections from some Republican senators led the final bill to preserve the deductions, but only up to $10,000 a year, meaning that homeowners in places such as New York will no longer be able to lower their taxes to Uncle Sam with the money they pay to Albany. Passing of the bill has led some tax experts to tell clients that they should look into prepaying their 2018 property taxes in 2017 so as to be able to take them off on their 2017 return in the spring. Also, for property owners, the deduction that allows people to take off the interest they pay for their mortgages is now capped at home values of $750,000, down from $1 million before. The cap will go back to $1 million after 2025. Exemptions and child tax credit: in 2017, taxpayers can claim personal exemptions of $4,000 for themselves, their spouses and dependents. They are most often used by those in the lower and middle class as they phase out in higher income brackets, though the Republican bill is eliminating them altogether starting in 2018. The Senate-passed bill does include a doubling of the child tax credit, however, raising it to $2,000 and raising the refundable portion to $1,400 after a stand from Florida Senator Marco Rubio.